In this video, we conclude our discussion on Chapter 6, where in our last video we went over the cross-price elasticity of demand. In today's video, we will discuss the income elasticity of demand by going over some preliminaries to then go over the income elasticity of demand, then conclude with an example. Beginning with our preliminaries, in our last video we addressed the question of if the price of good Y changes, then does demand for good X increase or decrease, and by how much, where we answer this through the cross-price elasticity of demand, which quantified a change in demand in percentage terms due to the price of other goods changing, where this yielded us being able to classify if goods are complementary or substitutes, as well as the strength of that relationship given the response type of either elastic, inelastic, or unitary elastic. Now we seek to address the following question of if income changes, then does demand for a good or service increase or decrease, and by how much? As this will allow us to determine if a good is a normal good or an inferior good, where normal goods are goods that increase in demand with an increase in income, whereas inferior goods are goods that decrease in demand with an increase in income. Additionally, this will also allow us to determine the strength of that relationship due to either yielding an inelastic, elastic, or unitary elastic response type. The way that we'll go about this is that we'll answer this question of interest by quantifying a change in demand with respect to a change in income, where this will require us to use the income elasticity of demand, which we'll define as the percentage change in quantity demanded divided by the percentage change in income. Or mathematically, we have precisely that, where we have the percentage change in quantity demanded as our numerator and the percentage change in income as our denominator. And as we saw with our prior discussions on different elasticity types, we also have our percentage change in variable formulas, where the percentage change in a variable is just going to be the change in that variable divided by the average, where the change in a variable is going to be our standard slope calculation, that is x2 minus x1 or y2 minus y1, depending on which variable of interest we're looking at, and the average is going to be the midpoint of those 2 points. So in the case of x, it's going to be the sum of x1 and x2 divided by 2. Now, with the income elasticity of demand, this will allow us to make the statement in the form of if consumer income increases by 1%, then quantity demanded for a good will change by beta percent, where as we saw with the cross-price elasticity of demand, the income elasticity of demand can also take a positive or negative value, and this will be contingent on if the good is a normal good or an inferior good. Additionally, the income elasticity of demand may take on a inelastic, unitary elastic, or elastic response type, which will determine the strength of the relationship of the normal or inferior good. So to proceed, let us consider the cases of a positive and a negative value income elasticity of demand. Beginning with the positive case, if should the income elasticity of demand yield a positive value, then we will have a normal good, where once again, this is going to be a good that increases in demand with an increase in income, where most goods typically are normal goods, where some examples would be chicken as a regular protein source in one's diet. Additionally, another example would be higher-end gym apparel, as they tend to last longer and are made of better material as well. Now, how impactful income changes are on demand will depend on the elasticity of the response, in that the more inelastic, then the less responsive quantity demanded is to income changes, whereas on the other hand, the more elastic the response, the more responsive quantity demanded is to income changes. Now, going on to our second case, should our income elasticity of demand have a negative value, then we will have an inferior good, in which this is going to be a good that decreases in demand with an increase in income, where such examples would be hot dogs as a regular protein source in one's diet, and an additional example would be ramen as a regular carbohydrate source, where the intuition behind an inferior good is if we relate this to our consumer who is going to the grocery store for their post-workout meal of ground beef and brown rice. Should their income decrease to where their ground beef and brown rice is no longer affordable, they will have to switch to alternatives that are affordable to them, or in this case this would be hot dogs and ramen, where both of these goods have worse macronutrient profiles than ground beef and brown rice, which is reflected in their price point. But should their income increase again, then the consumer will switch away from hot dogs and ramen and return to their ground beef and brown rice bundle. Now, how impactful these changes are on demand, though, will depend on the elasticity of the response. Where once again, if we have an inelastic response, then quantity demanded will not be very responsive to income changes, whereas if we have an elastic response type, then quantity demanded will respond quite well to income changes. So then, with some intuition on the income elasticity of demand, let us now work through an example using our consumer going to the grocery store with some income to purchase their post-workout meal of ground beef and brown rice, where we will consider how an increase in income will affect the demand for ground beef. And given that protein sources are a staple in diets and one tends to be included in most meals, and in addition ground beef serves as a protein source, and depending on the lean ground beef that is purchased, varying from 73 to 93, so on and so forth, it can also serve as a fat source as well. So based upon this information, would we expect ground beef to be a normal good or an inferior good? Let us see what we find out in terms of what this consumer thinks. So in our example, if income increases from $20 to $25 and the sale of ground beef increased by 2 units, how does the demand for ground beef change and with what response type? So we have our product demand curve on the right, and we also have our demand schedule, price on the vertical, quantity on the horizontal. We have our initial downward sloping demand curve, ground beef demand, and we're starting at point A, where at point A, demand is 2 units of ground beef at a price point of $2.50. So after income for this consumer has increased from $20 to $25, ground beef sales has increased by 2 units. So then there's been a change in demand since the price point of ground beef has stayed the same. Income has increased. If we were to relate this to the budget constraint, this means a rightward shift in the budget constraint, expanding the possible options available to the consumer, such that they purchase 2 more units, so we have a change in demand, yielding a rightward shift in the demand curve going from ground beef demand to ground beef demand 1 in purple, in which we're now at point B, where once again the price point is still the same at $2.50, but quantity demanded in terms of ground beef is now at 4. So based upon this information, we know that we are considering going from point A to point B due to this change in demand. Additionally, we know that we need to use our income elasticity of demand, which is going to be our percentage change in quantity demanded divided by our percentage change in income. Additionally, we know our percentage change in variable formula, the change in variable formula, as well as our average variable formula. So let us go through what the steps are. It's going to be similar to what we saw with the price and cross-price elasticity of demand, in that first we need to find average income, then we need to find the change in income. This will allow us to then find the percentage change in income, where we will then repeat the steps, but now do this for quantity demanded for ground beef. Then we put it all together to calculate our income elasticity of demand, and then we interpret the good type as well as the response type. So let us begin. In terms of average income, this is going to be the sum of 20 plus 25 divided by 2. This is going to give us a value of 22.5. Now in terms of a change in income, since we're going from $20 to $25, our X2 is going to be $25, our X1 is going to be $20, so 25 minus 20 is going to give us a value of 5. So then in terms of our percentage change in income, this is going to be our change divided by our average, so 5 divided by 22.5, giving us a value of 0.22. Now repeating the process but for ground beef, average ground beef is going to be the sum of point A and point B, so our quantity levels of 2 and 4, giving us a value of 6, divided by 2, giving us a value of 3. And then in terms of the change in ground beef, our X2 is going to be point B, so quantity level 4, and our X1 is going to be point A, so our quantity level of 2. So 4 minus 2 gives us a positive value of 2, such that our percentage change in ground beef is going to be our change divided by our average, or 2 divided by 3, giving us a value of 0.67. So then when we put it all together and we divide our percentage change in quantity demanded for ground beef, 0.67, by our percentage change in income of 0.22, this gives us a value of positive 3.04. So with the positive value, we know that we have normal good, and if we were to take the absolute value, we still have a positive number, and when we compare that to 1, it's strictly greater than 1, so we have a normal good with an elastic response type, where in terms of the interpretation, this means that a 1% increase in income will lead to a 3.04% increase in quantity demanded for ground beef.